Good morning. This is Dennis Wilburn with the Active Trend Trading from the Active Trend Traders. Welcome to How to Make Money Trading Stocks webinar that we do every Friday. I've got Mike Traeger on the line from Dallas, Texas. Mike, how you doing?
Hi, everybody. Glad, well, I don't know if I'm glad to be back. I was in California for a few days.
Yeah, we were able to meet up over in Palo Alto, have a great lunch, and chatted about where we think the market's going. And I don't know if we came to any conclusion, Mike, other than we both agreed. I think we both agreed that it may continue to be propped up for a while, but when it finally decides to dump, we think it's going to be a fairly significant dump, but we'll wait for time to tell.
Oh, yeah. Well, what else can we do?
So I want to remind everybody that all the materials that we present are for training purposes only. Traders should always paper trade any new method prior to the risk of their own personal capital. I am a big proponent of paper trading, and it helps work. I mean, it's just like practicing on the golf course. You go to the driving range, or you go to the putting green, and work on the nuances of your game there, and then you take it out on the golf course, and then reality sets in. So let's see, Mike, this past Wednesday night we did session 4 on the candlestick reversal patterns. We finished up with both the kicker and the doji sandwich. I will be gone for next Wednesday's meeting, and basically I have to go back to help my mom out. She's been having some struggles. She's 85 years old, and so I've got to go take care of some personal stuff to make sure she's properly cared for. So our next session for the midweek market sanity check will be August 12th, and we'll be covering Fibonacci's, the hidden support and resistance from the magic Fibonacci's. So this week, as we wrap up both the end of the week and also the end of the month, we're living in a world of mixed up markets. Just as I was going on, I was taking a look, and it looks like we do have another session of mixed markets today with, I think the Dow's down a little bit, the S&P's up a little bit, and then also the Russell and the NASDAQ are up a little bit. The SPX is approaching resistance, but it's just basically rolling within a range. We'll see that on the chart here shortly. The NASDAQ's kind of looking kind of interesting, Mike, because it may be putting in one of those classic bearish patterns where it's made a new high, eased back in a pullback, and now is struggling to get back up into the past resistance areas. And at least that's what I'm seeing on the chart right now. Can it be different than that? Who knows, but it's looking kind of interesting. And then the Russell. Russell is currently in a downtrending channel. It's having a nice little move up today, but it is hitting up against resistance and looking like it maybe want to turn back down within the channel. The outside influences and earnings. Earnings ups and downs as you've seen over the last week, 2 weeks, and it'll continue into the next 2 to 3 weeks, where the rest of the major portion of earnings is done. But on the big stocks, the supposed leaders, if they've disappointed in any way whatsoever, they have been hammered to the downside. And on the other side, you get the situations like Amazon, which reported well, and met expectation or above expectations, launched out. But as you'll note with Amazon, if you take a look at their chart, yeah, it gapped up and ran up really hard, but then finished with a sell-off candle. And so while it has not given back all its gains, it wasn't looking exactly, really, really strong. So ups and downs with earnings. And thanks to the Fed, we will continue to sit on our hands, pins and needles, with the interest rate jitters for yet another month. So Mike, what do you think the Fed's just playing with us?
Well, does anybody who's listening in still want to assign any credibility at all to the Federal Reserve as an institution or Janet Yellen as an individual? I mean, personally, I don't. I don't give them any credibility. And you know, it's just hard to explain, you know, what their collective frame of mind might be.
Yeah, yeah. And so, I mean, we already know that you know the government has gotten worse at cooking the numbers, and the unemployment numbers, the inflation numbers, and all that kind of stuff. Just you know, they don't have the same thing in them that they used to have. So you know, the credibility of even those is really suspect. And so it's always good to you know do a double check and get some third-party information like the employment participation rate and all that, and those kind of numbers to kind of get an idea. The number of people who are actually have given up and stopped looking. If those were rolled in and counted in the unemployment numbers, our unemployment rate in the U.S. would be above 10%. So
Yeah,
you know,
yeah. Yeah, and along those lines, and this is something I just sort of became aware of this week. I mean, the Fed, you know, claims to be holding back on doing anything because inflation isn't where they want it to be. And we know that the government and the BLS, you know, have a vested interest, I believe, in sort of fudging the numbers around when it comes to unemployment and when it comes to inflation. There is a website, and you know, certainly this isn't going to help with looking for a trade, but maybe just out of general, you know, interest. There is a website called the Chapwood Index, chapwoodindex.com, and what this, and I just became aware of it this past week, and you know what this is, you know, there's a guy who runs this website who has a basket of 500 items that he monitors in different cities, you know, nationally. And, you know, the idea being, what does it really, you know, what is the true rate of inflation away from the, you know, the government doctored statistics? And, you know, this basket of 500 items is, you know, pretty much the things that people spend money on. For example, you know, the cost of a pizza, a cup of coffee at Starbucks, a movie ticket, a gallon of gasoline, dry cleaning, things like that. And, you know, these are, you know, he adjusts this either 2 to 4 times a year. It's either every 6 months or quarterly, and not adjusted for anything, no seasonal adjustments, no inflation adjustments, just, you know, what is happening to these prices of real world things that people spend their incomes on, their after-tax incomes.
yeah, yeah.
And the difference between the numbers that he comes up with and the official CPI numbers coming out of the government are, you know, just mind-boggling. And for example, the one that stands out recently, you know, for the last 12 months for the San Jose area, according to the Chapwood Index, the cost of living inflation has been 11%. And the government will tell you that it's not even 1%.
Yeah, and I typed up the website, but I don't think I typed it up right. What is it? Chapwood Index or investments?
Chapwoodindex.com.
Okay, have I spelled that right? Right there on
Yeah.
Okay,
Yeah.
cool. Well, I'll leave that up. That way, when you check them, when people check the recording, that will be inflation info.
Yeah, it's just a more realistic look at, you know, cost of living increases in the real world.
Yeah.
And certainly the numbers we get from the government have nothing to do with the real world. I mean, we should know that by now. And as you said, Dennis, I mean, you know, check if you really want a better idea what's going on out there, you need to check some third parties, and I think this is one of them.
Okay, cool. Thanks, Mike. That's what I love so much about working with Mike, because where he finds us things, I just, I go, whoa, I'm always impressed. And the thing that's really cool, Mike, is while you're a great technician, but these other little extras that you add to the pie are just huge. So guys, I'll leave that up there for you to take a look at. Here's one of our favorite charts, the percentage of stocks. And I mentioned on the Wednesday night show that basically here, that was last week, this is this week. Mike, I was quite pleased. Well, I don't know if I was pleased or not, but Mike and I have been talking about this line for so long. People are just saying, stop talking about that line. And but the fact of the matter is basically we have been saying that while the market has been seeking and moving up to make new highs and this type of thing, the participation rate of the individual stocks within the index is not as great. And that's what this chart is showing. Basically, is the percentage of stocks in the NYSE above their 20-day moving average. And as you can see, as time has gone on since November of last year, remember in October last year, we get this beautiful, beautiful reversal. We head up, make a new high, but this goes back to November, but you can go back longer than that and see how this particular chart has been this negative divergence, if you will, or the indication that fewer and fewer stocks are participating in the rallies. This trend has been in place for quite a while, and we'll see. We get a nice little bounce off this week, up. Very little indication other than, if you bought the bottom, right at the bottom on a wild swag, a scientific wild, ask guess, you would say, okay, God, I got in really great and all that kind of stuff. But the fact of the matter is, it appears as if the market is starting to run out of steam a little bit as it's approaching the index, the past levels of resistance. So right now, this particular indicator is giving us good information, but not necessarily information that is not, a little. It's basically best to just go to the chart of the individual index ETFs and look for the levels of support and resistance, and then look to trade between them. And so, Joe, you're welcome. Joe said he thought the Chinese were the only ones who cooked the books.
We are much worse than China.
You think so?
I think China's just a little more open about it.
Oh, okay. And so, so this is a chart that Mike sent me earlier in the week having to do with something else. I took a look at it, but one of the things that really hit me is basically take a look at these lines. Okay, this is the line back in 1970. Oh gosh, right there, 1970, 2.5. This is back in the year 2000, and we'll get rid of those when we're done. This is 2000, 2007-ish, and I want to acknowledge that this chart came from the Hussman funds, and here was a little bit of a blurb about what they were saying. The rare indication of a last hurrah, and so special moments, and we just recently had another special moment, and there it's defined here. And Mike, I'm just going to, open up and say, hey, tell us what's going on here, because on July, back in 1972, we had convergence of clues where all these things came together and registered. 7 weeks later, after the market had climbed less than 4%, it rolled back over and lost half of its value. 2000, the warning occurred in March 2000. It rolled over, and we know what happened in 2000. It was a significant downturn. And in 2007, same. actually overshot this prior low before rebounding into what's been one heck of a nice bull market. But we just recently, on July 17th, all of these points down here, S&P at a high weekly high close. Bears, I'm assuming, Mike, yeah, walk us through what these indicators mean, Mike, briefly.
Well, okay. I mean, first of all, a disclaimer. I don't make this stuff up. I get it from somewhere else. And if anybody is interested in going to the source, you can do a Google on John Hussman and the Hussman Funds. He does have a website. He does run a family of mutual funds, and he writes, a weekly blog or a weekly column. He does a lot of historical market research, and he runs his investment funds accordingly. Not the best performing funds in the world, but not the worst ones either, but a real source of good information and a lot of intelligence in his application of that information to, current market, the current market events. So this comes from him and his website. And, in this past week's column, the gist of the column is, we're in sort of a unique situation that's only occurred maybe 2 or 3 other times in history, where you have what Dennis refers to as a convergence of clues. Well, for purposes of this chart, what are those clues? There are 3 or 4 things that are being looked at. The S&P 500 at a record high weekly close. The Shiller PE ratio, also known as the CAPE, the CAPE ratio, greater, above 18, and certainly it's been above 18 for years now. Actually, I think the current reading on that is around 27. It's been there for, months. The percentage of S&P 500 stocks above their 200-day moving average, below 60%, and actually currently it's below 50%, and according to what source of information you want to look at, it can even be read as being below 40%, which is really unusual. We've talked about market breadth, and the S&P 500 is hanging on to close to its record highs. In the meantime, more than 50% of the stocks in the S&P 500 are below their 200-day moving average. And, bullish and bearish sentiment, which is taken from a survey of newsletters, investment newsletters, and I believe that could be the Investors Intelligence weekly survey.
Right.
The bearish sentiment being below 27%. Bearish sentiment actually is way below 27%. I think it's about 15, and again has been in that ballpark for several months. So when you put all this stuff together, all these things happening at the same time, this has only happened, as Dennis has shown on the chart, 3 times in the last 45 years, and and this is the 4th time happening right now currently, and the previous 3 times this has come together, the markets eventually fell somewhere in the ballpark of about 50%. And this isn't a perfect timing indicator. This doesn't mean that the market's going to crash starting today or tomorrow, because it isn't. But I think it's a good indication of just how overdone things have gotten to be. We've been talking about this for several weeks or maybe even several months now. But just another way of looking at things, where we're at now, where we've been before, what has happened in the past. So what might we reasonably expect to happen going forward from here over the next year or two? And here we are.
Yeah.
And that's what the chart is showing.
Yeah, one of the interesting things, Mike, after you sent me this chart, I popped open and put it up on my own, my own charting platform. And there's one thing very, very interesting that at least I thought it was interesting. Let's say we are in fact for sure, let's say we're in a topping, mechanism, topping process right now. So what would be a reasonable target if in fact this does in fact, roll over at this point? Well, of course, it's to roll back to a level of support. Now, here's two very distinct levels, approximately the same levels. The high back from 2000, the high back from 2007, 2008 time frame, and if the market does in fact roll over here and fall back down, and even just to this particular level of support, that would be a 26% retracement from the high, which would actually be categorized as a bear market in that case. And that would reset a lot of the pins, but at the same time, you could always go lower. And we've still got this little puppy working here too, which is what's called an expanding top or expanding megaphone type top, which can be exceptionally volatile. But at the same time, even though you can draw the pattern in there, it doesn't necessarily mean that it's going to roll over, Tuesday of next week. Dorothy asks questions. Are the two long-term slopes about the same? I'm assuming you mean here and here. Dorothy? Would that show continuation? At this particular point, as long as that slope doesn't remain, this longer term slope, which we'll see on the charts here shortly, this does stay intact, that's going to continue, that is going to continue until it doesn't. But it doesn't necessarily, no, from 1977 to 1997, from here, and then to 2009. Here to here. Yeah, it's approximately. I don't know if this is a log chart or not.
Oh, it's a log chart for sure.
Yeah, but I just because we went on this huge long run here, I mean, there were a lot of things that were coming into the economy. We were, let's face it, it was a different world back in, 1977, because when Mike said 45 years ago, I just kind of went, oh my gosh, the 1970s were 40 years ago. That has made my weekend, Mike. I'm going to be depressed all weekend.
Well, I like your goatee beard that I saw the other day.
Okay.
You want to keep that. It adds a sort of a layer of distinguished to you.
Yeah, it's yeah. I have never actually done. Let's see. What do you make of the AAIA? This is from Richard. 40% bear sentiment considered considered a contrarian indicator. Richard, I don't follow AAII per se, but what they're showing right now is 40% bearish sentiment. I think that part of the deal with the bearish sentiment that Mike points out, and also the sentiment that Husband pulled out of being below 26, below 25%, something like that, is that it's an indication. I do think it is kind of a contrarian type issue, but the contrarian being, so many people think that are bullish, basically are thinking, hey, we're just going to continue going up, continue going up, continue going up, and eventually that weight of everybody jumping on board the train does take its does have an impact and eventually drive it down. Bull sentiment is only 21%. Again, I am not familiar and I don't follow either of those indicators from AAIA, so
I have a little superficial familiarity with them, and AAII is the American Association of Individual Investors.
Right.
And I think that's the one that gets published in IBD. It's individual retail investors like us, And I think it tends to be, I mean, at extremes, it is used in a contrarian way. And I think it tends to be a little more short-term oriented than the Investors Intelligence Survey. The Investors Intelligence Survey is a survey of professional financial newsletter writers. I think it tends to, it's professional versus retail, and I think it tends to be a little bit longer term in its outlook, and that's the one that Hussman refers to for that chart that we were just looking at.
Okay. And so here's where we're at. As of 9 o'clock this morning, the Dow was up a little bit, but for the year it is down about a little bit less than 1%. S&P actually came off of its lows with the on this latest rally attempt. A little bit better than the other indices have. You can see the NASDAQ and the Russell have had a slower reaction compared to where they were last week, a slower reaction to this latest rebound. And we're going to get in here and look at some charts now. As we're transitioning over to the charts, there we go. Gino asked a question, are there any ETFs for restaurants? Gino, I haven't got a clue. It's always something that can be Googled. I basically just track the index ETFs, and that puts plenty on my plate. So let's take a look at the S&P both on a daily and a weekly. As I mentioned last night, there's this resistance zone, and that is basically right about where it's at, just above the 210. It runs all the way up to 2130. And we have breached, the price action breached into that this morning, but appears to be, perhaps slowing down at this point. Earlier in the week, the S&P made a wonderful bounce off of the 200-day moving average. And again, these, in a really strong uptrend, one of the things you can note, and let's look at this on a monthly chart, Mike, because it is the end of the month. But let's look at this on a, yeah, popped up the monthly chart. There we go. Good. Let's take a look at across here. Okay, this reddish dash line equates to the 200-day moving average, approximately the 40-week moving average on the 40-week on a weekly chart. And as you can note, on a strong uptrend, typically that 200-day moving average is not going to be approached until you start getting up and start doing some topping type motions. And so earlier last year, mid part of last year, this was in the late September through mid-October timeframe, we did in fact have a violation of this and then popped back up, ran into a nice little run up prior to the end of the year. But then as we have continued on with this price action, it has again and again come back down to assault the 40-week moving average. And now we're finally getting to see some of that bending over, thus the sense that topping is a process, and it gives kind of that initial viewpoint of a rounded type top. You can see that on the monthly chart too. One thing to notice, and let me draw this in, there we go. One thing to please notice is that, again, both on a monthly and on a weekly, and we get back to the daily and the intraday, daily and the weekly charts, we are working within this range that has been in place now for 1, 2, 3, 4, 5, 6 months. And there's your high, about 2134 in the S&P. Currently, over the last 5 months, the low has been about 2043. And so having the patience to wait specifically until you're at the boundaries of the ranges can lead to some good trades, but they're really quick trades, last 2, 3, 4 days. And so, and Dorothy says that no, that the Seeking Alpha said there are no restaurant ETFs. And so as we look here, one of the things I was talking about last night on the market update is even though the price action on the S&P made this really nice little bounce off the 100-day. Look what's happened here. No response from the momentum. The true strength, yeah, a little bit of response, but it was muted, gets back up to the zero line and is now stalling out. And big time, look at the lack of momentum on a weekly basis on the S&P. It's basically been non-existent since about the mid portion of June. And one can say, okay, well, that's maybe the summer doldrums setting in where things tend to not be as active on the markets, or does it mean more? What do you think, Mike?
Well, yeah, I think it means more, and I mean, we've been talking about this for months, literally. I think it sort of ties in together with what we're seeing with the lack of market breadth and the lack of the number of stocks participating, the fact that it's really a relative handful of stocks that are driving these charts of the indexes.
Yeah.
Didn't you mention to me a few days ago, Dennis, that there was an article in the Wall Street Journal about this?
There was. It was basically, which just basically gave confirmation to what we've been seeing for months. But the concern amongst a lot of the institutions is that the breadth of the market is resting on, I think Jim Cramer mentioned about the 5 horsemen. Well, Wall Street Journal came out and said there's 6 stocks that are basically driving the market right now. Google, Apple, Netflix, Facebook, Amazon, Facebook, and Gilead. And those are the major drivers, and they're the ones who make up the greatest part of the of those weighted index. David T came out and said try PBJ for it's an ETF, Power Shares, Dynamic, Food, Beverage, McDonald's, Panera, Papa John's, and other ones. So let's. So what are we looking at here? It's very interesting. Here is the pattern. Please be aware of this. We came down. We basically made a higher high. We came down, bounced off the 50-day moving average. Everything is wonderful and good on the NASDAQ. And then we're popping back up, but running out of gas. If this, in fact, turns out to be a reversal point, then this would be that classic pattern that Mike and I have been talking about here recently, where a new high breaks back below well, that has nothing to do with it, but it comes back down to a support level, bounces, runs out of gas, and then reverses. This would be then a higher low, no, a lower high. There we go. And then we'll see what happens when it gets back into this resistance area. Again, the index ETFs and or the, well, especially to the downside, the puts on the index ETFs or other type of trades can be really, really good. But that's what I'm looking here. Mike, as we're seeing, we get last week we had a dark cloud cover. And today, this week, prices have pushed up to the midsection of this candle and are now, stalling out, hesitating. What's it telling us on the monthly chart, though? Here's the monthly chart over here. Let's see if I can zoom in a little bit on this. Basically, it's telling us kind of the same thing. Yeah, we pushed out and made a new high. Here is kind of like, I think, the line of demarcation, the 45.50 level, which was the breakout on the NASDAQ. And if that is busted to the downside, then we're probably looking at, at least a return back to this long-term uptrend that started back in the year 2012. And you can actually probably draw it back further than that, back to 2010. Let's take a look at the Russell.
I like, hang on a sec, I like this monthly chart. Something we don't talk about too much is the relationship between price and volume. And again, you can see divergences between price and volume. just like you can see divergences in many other things, and very often they do come to fruition. And not so much on this chart. It looks like they stopped showing volume on this.
Yeah, correct.
They just stopped showing volume. But I've seen charts in other places, and even if you go back, 5, 6 years, I mean, back to when this whole, market rally started in 2009, and you look at a monthly chart of, say, the spiders,
Yeah.
You'll a huge drop-off in volume as this rally has gone on, for years. It's just been happening on lighter and lighter volume.
Yeah, exactly.
And like most divergences, sooner or later they do reconcile, and one of two things has to happen for that particular divergence to reconcile itself. You're either going to get more volume coming into the market to drive the rally even further, or the price is going to have to pull back to reflect the lack of volume and the lack of breadth underlying the rally.
Yeah, so I rolled back the chart, the monthly chart, just for you to take a look at it. I suggest going back and looking at the 2007 final topping pattern, and look what your indicators. Look how the true strength is doing. Look what the momentum is doing. Again, I don't know why Thinkorswim stopped showing their volume on the indexes, but just take a look at that, and you can also roll that back further and take a look at longer time frames. But it's very interesting, and then roll it forward, not looking for per se the exact movement, but just to say, okay, what's similar and what's different, what and how do I need to be adjusting my own perspective of what I think the market's going to do. Let's take a look over here at, did I go to the Russell? I think I did. Let's take a look at the Russell just real quick on a weekly, monthly. And as we see, the Russell has, let me get rid of the, okay, as we see, it came down to a long time support level at about the 1200 level, and it has rebounded up off of that. It is hitting into the 8-week moving average, which approximates the 50. But again, look at the lack of, the momentum is just still falling off longer term. After making this really huge run during 2013, going sideways, even though we have pushed up to newer highs in the Russell on a monthly chart, it too is locked within a it's range bound right now. In one way, one of the things that Mike and I were talking about is even if we didn't, roll over and, drop into a significant bear market or even a significant correction, the Russell, if it just bounced between this range over the next few years as it's working off its issues, that would be a very tradable opportunity. But as we see over here, negative divergence, and on the
when we look at the candlesticks for the Russell monthly chart, monthly,
yes,
you just had it up.
Yeah.
Looks like last month we put in a shooting star.
Yep.
Yeah. And this month, which is over as of today, almost kind of a hanging man type candlestick following the shooting from last month. And given your recent review of reversal candlestick patterns, I mean, that's, back to back, these two candlesticks the past 2 months are pretty classic reversal candlesticks.
Yeah, that's and especially when you look at them on, when they line up about there, if there's one reversal candle followed by a second, again, this is clearly, not quite a hanging man, or not a perfect hanging man, but clearly at least a spinning top. But that is clearly a shooting star on a weekly chart. And as you can see over here on the monthly chart and here on the weekly chart, it's just basically hammering between the resistance, support, and here's the lower portion down here. I think that one of the things, the Fed didn't do the Russell any favors by saying, we're not quite sure when we want to raise your rates yet. And Mike, I think it will add to the volatility in the Russell as it prepares for the September Fed meeting, because the small cap stocks tend to get hammered around, or they tend to not like the even if it's just a minor adjustment in interest rates to the upside, they tend to not like those. So the Russell, what are we doing? We talked about the weekly chart previously, and let's take a look at what happened here. Yeah, we get a nice little rebound, huge hammer, and it's moved back up. Where did it stop today? Right at the 100-day moving average. And so as long as this is not broken, or as long as we don't break that and stay above it, I would look on the Russell for things to basically resistance, support down here at the 100, or traction 200, so that can define kind of a new range for us on the Russell. Again, poor momentum on a daily chart is turning up a little bit. And but as long as the price action or the TSI is living below the zero line, it could come up here just a little bit more and then reverse back down. Now be on the lookout. I mean, one of the things I did think was positive this week on the Russell, Mike, was that we did make a lower low with the hammer, and we did get a positive divergence on the true strength. But we'll see whether or not that comes to see how that plays out over time. We'll be keeping an eye on that.
Yeah, the bigger picture perspective for me there on the daily chart is that we put in a high back here during the month of June, pulled back to a low, came back and put in a lower high, then took out the July low and put in a lower low. So now we have a couple of pretty well established areas of lower highs and lower lows. This rally that we've experienced the past few days off of a temporarily pretty oversold condition on the Russell daily chart is doing nothing so far but going back to put in a lower high.
Yeah. I agree completely.
That is the very definition of a downtrend, at least within the time frame of that chart, which is a daily chart.
Yeah, and this is the pattern. This down up to a lower high is what we're looking at, the potential of the NASDAQ to be doing right now also. So that's it on the indexes. Let's see if we've got any questions. Dorothy asked a question, in candles, are they in play for a few days in the future after they happen? And if you get a reversal candle type, Dorothy, that reversal candle can stay in play until it is voided. In other words, voided by a penetrating the low. If it's a hammer, if it you get a close below lower penetration of the low, then that voids the signal. And then often if it does bounce from a hammer, then that particular hammer may no longer be valid, but it does define a level of support for future trading, where if the pattern, if the price action reverses down and comes back and touches that. So if it's voided, it is no longer valid, but it can stay active for numerous days. And if it's a weekly chart, numerous weeks, monthly chart, numerous months, as an indication of that's where the reversal happened. Let's see here. Where am I? Is that you, Mike? Nice sound, man.
Yeah.
Is that your phone?
Yeah. Interesting enough, and you know, I do apologize because I am going to have to leave the presentation here soon. But earlier we were talking about, you know, the government statistics, the rate of inflation, needing to check third-party sources of information because the government statistics are so heavily doctored. I had spoken about this with a friend here who's employed in the financial industry, and I had mentioned this Chapwood Index to him earlier in the week. So the background noise you just heard was a text message that was just coming in to me from him saying he just took a look at that and he is shocked. And shocked was his word. So that's what that noise was.
Yeah, and so, okay. Just want to remind you of what the active trend trading system is all about. 5 pillars. You know, we trade only top quality IBD growth stocks and index ETFs. Follow the system for where to enter, where to exit, what strategy to use, one of 3, and what to expect. Here's where we're sitting as of the 9 o'clock this morning. We've basically made up the little offset the market provided us last week, and we're back up heading in the correct direction. And here are the 3 strategies that we focus on. Stocks, index ETFs is long and shorts, basic options. For premium members who are in the special trades portion, be looking for some additional basic options next week, some trades, and then wealth and income generation, which we take basically as just holding a long leap type position like this one in the S&P. I bought back on 420, which was my anniversary, the long January 2017 210 put on the spiders, because I think sometime within the next you know, between now and January 2017, we're going to get a pretty nice correction in. But while I'm holding that, I'm selling premium against it. And right now, let me go back to here. Right now, we have sold a little bit over. We took a hit last week, but we made up a big portion of that this week in the positions that we held. I've got 7 contracts. And so since April 20th, we've collected about almost $2,900 in premium, which equates to a current running return of about 27% on that trade. Again, with this particular trade, we are not worried if it basically closes completely where the underlying long put is worthless. Between now and January 7th, 2017, we will generate enough premium to both pay for that and have an additional profit. If the market happens to go fall, that much better for the long position. Or if it closes, you know, at a position in 2017, there may be some residual value there. We've got one thing going on. We've got HWK. Got in at 44.50 this week. It's up a little bit so far. Again, watch for some simple options coming out next week. And then strategy 3, we were actually able to close all of our positions on the short put that we were long for a profit of $125 this week, and now we have already put in place and sent out the orders on this about $518 worth of potential for next week. Early warning alerts did not give us a specific trigger to get into a trade, but for those aggressive traders who did take the initial email that says if you're aggressive, you know, go ahead and get in now. On the entry of that day, UPRO entered trade on UPRO entered at approximately 67.84, is now up about 3.5%. But from that dive noise that I just heard, it may not be up for long. That's one of my alerts that just popped off. If you're listening to and watching the How to Make Money Trading Stock show, just we like to offer a potential for you to become a member with Active Trend Traders, either through the early warning alerts or the active trend trading membership, which we provide a lot of training on that. You can go to this website here, and it will link you to the discount membership. So Mike, I don't know, is Mike gone? Mike's gone. So I want to just say, hey, see you all next week. Have a great weekend. I will be broadcasting next week from the heart of Paragould, Arkansas. I will have my hotspot with me so that we can make presentations from there. And yes, it looks like the market is rolling over a little bit. We'll see where she goes from here. So thank you, David. Appreciate that. Now it's time to the part that I like probably as much as any of it is just, hey, let's take a look at some stocks here. And I already have, let me expand. Gino, you asked about restaurant, and this is one of the cool things. David came up with PBJ, that's Papa, Bravo, Juliet. And another one is Papa, X-Ray. No, Papa Echo Juliet. Excuse me, Papa Echo Juliet. And yes, I did learn how to talk like that in the Navy. So, okay, what else? Let's see. I'll just whip up one of those really quick and just take a quick look at what kind of volume it puts out. Very, very thinly traded for an ETF. I mean, average is less than, oh gosh, less than 100,000 shares per day. Just FYI. So let's take a look at some stocks. FANG. Gina, do you want us to look at FANG or Gilead? FANG is this is a perfect example, guys, of well, it's got earnings coming up. I wouldn't do anything with it right now, but while it's important to look at a side by side. On the left-hand side, you've got the daily of FANG, which looks like it's a very negative type pattern. It's in a huge downtrend and all that kind of stuff. But look over here on the weekly. In fact, it's coming down, retesting down into support level. In a longer term basis, this could be considered, it perhaps might be a higher low on a longer term basis, and it may rebound from there. We'll have to see. Again, it's got earnings coming up here shortly. GILD. Oh, okay. Gilly, this is one of the stocks that have been highlighted as to be in. XLY is okay. This is Select Spider Trust. It is breaking out to a new high. XLY. I know that. What sector is XLY? Oh, okay, consumer discretional. Okay, thank you. Again, with this type of index ETF, or in this case, the index, well, not the index, but the sector ETF, is take a real hard look on how far it does in fact move. So in other words, from here to there is only about and that's a several day move, that's only about a 3.2% move, or from its low over here. Some of them, while, I mean, they are slow and steady, they can be really good for learning how to do technical analysis, but once you learn how to do the technical analysis, you can, like it's got, you know, it's on 17% for the year, not bad. But you just, it's one that they are slow movers. Let's see. Amba. Amazon in the process of doing a bit of a it came down here in this pattern here, hit off the 50 and then rebounded up into perhaps a double top type process. And the thing that's very interesting, double tops and cups look exactly the same. When do you know which is which? Is after the fact. Does it break out from the top of the cup, or does it in fact just hit there? That's as far as it's going to go, and then breaks the bottom of the cup, saying, "Hey, we're gone." And okay. I just had to check them. SWKS is a very interesting stock. It has basically set in again. Short term looks very negative. Looks like it may be putting in a head and shoulders type pattern up here at the top. The key crucial point is the 92, 98, 93 area, even 92 area. This could be considered a low volume wedge up, and it has broken the 50, so it is wedging back up. And so right now, SWKS is on my short list, my list of stocks that could potentially be shorted. And so, okay. So any other stocks, guys? I want to let you know that while we've been chatting, Blackhawk has reached up and has hit into its resistance area. That's 46, and we'll see if that pops up. We were into Blackhawk earlier this week at about 44.50, which is approximately there. As it was pulling back up, put in a bullish harami here on Tuesday, and then has made a nice little rebound. Our initial target based on the distance from here to here and then extending that from here to here is about 47, 47.40-ish, to just take some of the profits off the table. I'm not going to take all of them off the table because I think that, this is a stock that's been highlighted in the leaderboard. And it may have some good potential because if the market does go into more of a correction or at least a stronger pullback, there will be some stocks that continue to do well. So Hawkeye is one of them. What's the topic for tomorrow's BAM meeting? David, we're going to be talking about candlesticks. And so any other stocks, folks? Awesome. Look forward. Yeah, Dave, for those who are not in the local area, David and I attend a group that's called the Bay Area Moneymakers it's a meetup group, and we meet once a month, and so that's the first Saturday of every month. If you're in the Bay Area and you want to come and check that out, you can do that. Electronic Arts. That looks pretty good, Judy. When are we going to report, or did we report? Okay, we reported on 7:30. Beat estimates. It's kind of interesting. The guy who originated Electronic Arts, one of the founders, actually goes to our church. And interesting guy. Give a little bit of history about how they developed Madden football and all that kind of stuff. At least I think that's Electronic Arts. Is that the one that does Madden football and the games and all that kind of stuff? Okay. And so right now, I mean, it's definitely, basing here. It's above the 50-day moving average, above the 20. It's got, what's its range on a daily basis? Not too bad, about $2. It's got good volume, over 500,000 shares. One of the things that is concerning is to see how this momentum, even during earnings, while it's moving sideways, getting a little bit of positive, the actual momentum hasn't started to get positive yet. But it's looking like, it's looking like it is searching for a place to turn around to go higher. Market conditions may be holding it down somewhat, but certainly something to keep on your list. And this is a nice move that's made here from the beginning of the year. Yeah, it's got about a 50, almost a 60% gain since the beginning of the year. Not bad. Okay, here I'll pop out a couple that I am. Well, the networks, I have not looked at this today, but it was looking kind of interesting earlier in the week as it was pulling back down to this level of support. Let's see if momentum comes back into it, and it pops back up into a to the uptrend to go back and challenge these highs again. Again, will be affected by the market itself. Netflix. Okay. Yeah, I missed Netflix yesterday. This little hammer, spinning top doji, and rebound off the 20-day yesterday was the signal to jump in for about a $7 gain, $8 gain on Netflix. Netflix is remains high on my list of good companies. LCI. We had traded LCI last week. It actually got stopped out of the order as it dropped back down here to a newer level of support and then rebounded from there. Looks like it's struggling a little bit though as it's pushing up to back into this resistance area. So we'll see how that shapes out longer term on a weekly chart. Looking like, okay, it's found a level of, where it wants to support itself. Will the momentum now kick in to, take it on a higher trajectory? And then the other one was G-Pro. Again, broke out, retested, and then pop back up, and it looks like it's rolling over a little bit. And so let's see if it retests here, because this is from 60 up to 64 or $65, which that may be its lateral range for a while. So any other questions, folks? Okay, I want you to have a great weekend. If you're in the Bay Area and can make it by the Bay Area Moneymakers, we will look forward to seeing you. Have an awesome weekend, and I hope that the insight that Mike and I try to provide, is valuable to you as you assess where you want to go in the market next week. Have a great one. God bless everybody.